You've probably heard a money manager, broker, or financial expert claim that they beat the market last year. What exactly do they mean when they proclaim to have beaten the market? And what amount of risk did they take to, quote, beat the market? Today we're going to talk about ways for you to assess the validity of market outperformance declarations, but first, let's talk about what the market is. In general terms, the market is most often defined by indices such as the Dow Jones Industrial Average, the S&P 500 Index, and the NASDAQ Composite Index. These indices are bellwethers of the U.S. economy. Some mutual funds, exchange-traded funds, and other funds are designed to track the performance of these indices, especially the S&P 500 Index. So if the S&P 500 Index was up 5% last year, and a money manager proclaims to have managed a portfolio of assets which was up 7%, he might boast, "I beat the market by 2 percentage points." As crazy as it seems, because 7 is 40% more than 5, some managers even stretch the truth by saying, "I beat the market by 40%. Well, that's technically correct, but it's very misleading. In order to assess the validity of a money manager's claim to have outperformed the market, one must know the components of and the risk profile of the assets managed. Let's look at a simple example. If the money manager had an asset allocation of 50% in an S&P 500 index fund, 25% in an emerging markets fund, and 25% in a small cap fund, you would logically assume the emerging markets fund and the small cap fund outperformed the S&P 500 index. For the purposes of this example, you would be correct. However, you should compare the money manager's 7% appreciation performance to a portfolio comprised of the same allocation of 50% in an S&P 500 index fund, 25% in an emerging markets fund, and 25% in a small cap fund. If, for purposes of illustration, the emerging markets and small cap sectors had each gained 12%, the weighted average return for such a portfolio allocation should have been 8.5%, not 7%. So in this illustration, the money manager underperformed the market in which he was invested by 1.5 percentage points. Yes, he beat the S&P index by 2 percentage points, but he should have delivered a return of 8.5%, not 7%, based on his asset allocation. So when an investment professional claims to have beaten the market, very likely there is more to the story. How much risk did he take to achieve those superior returns? Based on the asset allocation of the portfolio he managed, did the professional really beat the market? In this example case, and very often in real life, the investment professional did not deliver above market returns for his asset allocation. Why? A very common reason for underperformance is active management. In this example, it would be safe to assume the investment professional attempted to time the markets in which he participated by frequently buying and selling the assets in a failed attempt to outsmart the markets. Had the investment professional simply taken what the market offered and not tried to outsmart it by actively trading the portfolio, his clients would have been economically better off. While active management can yield superior returns, rarely are those returns sustainable or worth the risk incurred to achieve them. So be wary when somebody says they beat the market. Very often there's a lot more to that story.